Jasmine, and we're keeping an eye on the turmoil in world trading this morning. U.S. stock market tumbling again this morning in reaction to the first ever downgrade of the U.S. credit rating. As we take a look at the Dow right now. On Friday, meanwhile, Standard & Poor's cut the nation's top-ranked AAA rating to AA+. Joining us for this morning to explain what this means is Professor Sumner LaCroix of the UH Economic Research Organization. Good morning, Professor.
Good morning, Kenny.
Hope things are well. We know that the stock market is not doing well, but let's talk about the S&P, their rating. How did they come up with this downgrade? Why? And explain that process.
You know, rating the credit worthiness of governments is a big business. The state of Hawaii has to get its credit rated in order to sell bonds. The county of Honolulu has to get its credit rated. The country of Italy has to do it. But with the U.S., no one's ever taken it very seriously because we've never defaulted.
Right.
And we've really had pretty rock-solid finances over the years. So what they do is they have a model. They have a model where they basically do a stress test. They ask themselves, if the U.S. economy, for example, faced another war, there was a recession, revenues went down, and we had all these extra expenditures, would it be able to meet its obligations? And on the basis of that and a whole bunch of informal discussions, essentially S&P decided to downgrade it.
And Standard & Poor's, when they come up with something like this, when they downgrade the rating, is it a group of economists, 10, 100? Do we know that?
It's a whole bunch of people. I mean, you know, it's
professors like
top
yourself,
people.
Right.
It's top people, and they circulate the recommendations among a large numbers of people at the firm.
Okay, so what are the consequences for the everyday investor now that we have been downgraded from AAA to AA+? What are the consequences for investors like me if I'm looking to buy a house? Will interest rates rise? What if I'm trying to invest in bonds and treasuries?
You know, I think for people who follow the economy, it's worth noting that the S&P report didn't have any new information. Okay, and that rational markets move on new information. There's no new information in the report. We knew everything that was in there. However, for ordinary people who aren't spending all their time following the economy, there have been two ominous signals in the last month. The first ominous signal was the political circus in Washington over raising the debt ceiling. It got people thinking, is the U.S. government capable of coping with these crises? Here's another thing where another signal comes out. Maybe the U.S. can't pay its debts. And so I think what this is going to lead to is people taking a second look at their investment portfolio and asking, am I taking on too much risk? Here's U.S. government bonds now being rated as more risky than before. And do I have too much risk in my portfolio? So what I expect to see over the next month or so, maybe longer, is increased volume in the markets and probably some increased volatility. As to which way they'll go, I'm not sure because there really is no news in the report. We knew all the bad news about U.S. deficits and everything else beforehand. What
we do know is that the stock market has been reacting this morning. The Dow going down more than 300 points. Right. We saw more than a drop of 600 last week in total. Legitimate concern in stocks right now, or is this, again, another sign of just jittery investors?
You know, it's a weak economy in the U.S. We have a crisis in Europe over the euro. And all the countries there are getting into debt problems. And there's a lot of other things going on beyond the S&P. I wouldn't read all of the decline in the stock market this morning into the S&P, but some of it. But really, there's going to be a lot of nervous investors thinking, am I taking on too much risk in my portfolio, and thinking maybe I should move into quality. Here's the amazing thing. Okay, now that S&P has decided that U.S. Treasuries are more risky, people are fleeing into risky U.S. Treasuries. Okay, so it's kind of like we're saying that the Indianapolis Colts have lost their quarterback for the year, and now bettors go to Las Vegas to double down on their bets that they're going to win the Super Bowl. Okay,
right.
Now
it's hard to explain.
So part of what this is saying is it's not clear that these Treasuries have really become all that much more risky, but it is an ominous signal out there.
All right. Well, Sumner LaCroix, thanks for that information. We'll be definitely checking in with you as we continue to watch the stock market this week. And don't forget, you can watch this interview again by heading over to the morning section of KITV.com. We'll be right back. The time now is 6:38.